Hi, everyone. This is Rohit from Lifestyle Mastery, and today I'm excited to have Carter Williams, who's the co-founder and managing partner of iSelect Fund, a venture capital fund that invests in innovative companies that push humanity forward. Over Carter's career, he has directly managed investments of more than $600 million in early stage ventures. Carter has done his MBA from MIT Sloan School and has done his bachelor's in mechanical engineering. Welcome to the show, Carter.
Thank you very much.
Awesome. So, I was interested to know, how did you get into this world of startups and venture capital, and how was your childhood experience while you're growing up?
Yeah, so it's early on, I think I almost electrocuted myself when I was about 3, taking a wall socket apart. So I've always sort of been in the realm of technology. Early on, building things as a kid. I went to engineering school at RPI. From there, ended up at McDonnell Douglas building fighter aircraft in the early days of Six Sigma and Lean, and was very involved in really some of the most cutting edge work, both on the F-18 program, C-17 program, a lot of aerospace, and that's always a very challenging area where you can really push the envelope. I went back for my MBA at MIT Sloan and concentrated on technology investing and R&D management, and that led me back into what then was Boeing, which Boeing had bought McDonnell Douglas, and was part of Phantom Works in Boeing, which focused on the far side of really technology that still is not visible today, to practical technology in space and commercial aircraft and military and all those different types of systems. So that was a great incubator. While I was at Boeing, I was both involved in R&D strategy. So where should Boeing invest all of its research and development dollars every year? And then we evolved that into the ventures group, which was focused on how do we work outside with startups to advance the ball in technology and in aerospace. So we were talking about things like SpaceX in 2000. We, as a firm, we didn't figure out how to get out of our own way, but the idea of like commercial space in a very open entrepreneurial way was something when I was at Boeing we were working on as early as 2000. And so I've been involved in those in various ways. I was working for the CTO who retired in 2004, and I used that opportunity to say, maybe it's time to leave. And got involved in one of the early IoT companies that was focused on building controls. And we built a company named GridLogix, which would monitor thousands of buildings and figure out what was right or wrong in terms of how they were operating on their energy systems. And so we could reduce their energy usage by about 20%. We grew that company and sold it to Johnson Controls in 2008 when the stock market was crashing. It's always good to exit for cash at that point, but that became Johnson Controls Panoptic system. And then the whole IoT market sort of exploded after that. And since then, I've been involved in various startups as an advisor and such, and really got into a point where I really didn't need to work, but we got to a point where I've spent my entire career around technology in various ways, and when it's succeeded and when it's failed. And so we started iSelect to really address the fact that when you're outside of Silicon Valley, outside of New York, access to capital is a challenge, access to talent, access to early adopter customers is a little murky, and we started iSelect as a framework to try to bring more capital to the whole rest of the country. And now we invest overseas too now, so to other areas to bring smart capital into those areas to help grow. We've concentrated more around the food and health space, but it really, I'm a technology, I'm less of a VC and more of a entrepreneur technology guy. There are other people on our team that are a little bit more, VC finance like, yeah. But my brain is always spread across the framework of how can we apply technology in really novel ways to solve big problems and come up with better answers.
Interesting. And what is the thesis for iSelect Fund? Before the call, we were talking about food and agriculture and healthcare. How did you come to focus on this particular thesis? And maybe if you could elaborate more on that.
Yeah, so sometimes I say we're two things at once. So thing one is food is health, food agriculture. Thing two is we're fintech startup. So covering thing two is we are an open-ended evergreen fund. We've got 500 LPs. We raise capital from institutional investors, from family offices, from RIAs. We do that consistently. We're always adding to our fund. The fund never closes. We're always fund one. And so there's a whole bunch of craziness in reshaping venture in that way. Sequoia is sort of moving to that model. So we sort of were ahead of the game. They're a lot bigger than us, but there's a shift going on in venture capital there in terms of how capital is brought together that we sort of started with the fund. Putting that aside, to do venture capital well, I personally think you got to be close to customers. We were founded in the St. Louis area. St. Louis is extraordinarily strong, probably number one in the world in ag innovation and probably in the top 10 in healthcare. And so we just have a natural ecosystem around us of people who've been both customers of that problem and people who've been solving the problem out of WashU, out of Monsanto, out of a regional area called the Danforth Plant Life Science Center. And so we concentrated as we started the fund, and we were sort of solving two problems. How do we bring capital to some less well-served markets? And then what sectors are we going to concentrate in? It just sort of naturally evolved in this sort of health food area. There's also a great chart that's been shared on the internet recently that out of Mark Pryor, not Mark Pryor, I can't remember Mark's last name, but out of AEI about where we've seen inflationary and deflationary forces. So certainly Silicon Valley's done a great job of bringing down the cost of tech-related things, but areas like education, food, healthcare still sees a lot of inflationary forces. As a fund, we're really more interested in those places where costs are going up. Innovation is a deflationary force, and so the first areas we're concentrating are around agriculture, and healthcare. And then in time, as we continue to grow, we might start to wander into some other areas that have seen sort of inflationary forces to try to turn those around.
Interesting. And iSelect Fund is like a VC fund, but is there a crowdfunding attributes also to the fund, and how do you select the investors, and how do you select the startups for this particular for the platform that you've built?
Yeah, so what we've done on the platform side is we've used the provisions of the crowdfunding laws to create a very open fund structure. But we created an institutional framework around it. So our concern was that some of the early crowdfunding efforts were, here's a deal, no one's gonna do any diligence, make your own decisions, invest, and here's an SPV and pull things together in some particular way. What we believe is that there are a set of investors that want to invest that have not traditionally done venture capital, and they don't have time to do the diligence. So we differ from some of the crowdfunding platforms, and internally we look like a venture firm. We have associates that are digging in on the diligence. Everything we do looks exactly like a venture fund in terms of the depth, the scope of the diligence, our participation in the companies, whether we sit on the boards or not, all of that we do. And so we're different from some of the crowdfunding platforms in that way. The other thing is we've institutionalized the fundraising process. So we are registered in particular ways that are necessary to go into broker dealers and financial advisors, and we have licensed people that are salespeople out of places like Goldman Sachs that reach into those communities. We are working with large family offices that, we've got one family office that has more than 30 billion in assets that really doesn't do much venture, and so they're doing it through us. because they like the open-ended fund structure. And the way in which people do invest with us is it might be that they say, we would like to invest $1 million, invested in your next 25 companies. But then if there's a follow-on round, we want to relook at that. And then when they see that follow-on round, they might write a $2 million check. And so we've created the capability for a lot of family offices to have a high quality venture-like deep analysis and give them some flexibility because they don't really like being committed to long funds. A lot of larger capital providers that really don't like, right, they go to a venture fund, the venture fund says, you got to invest $5 million, we're gonna have capital calls. Once you make this decision, you got to stick with it. You can't reverse your decision. Our approach is we work with those people. They may commit $5 million. They might be intending to invest $5 million, but if we blow it along the way and lose their trust, they don't have to keep investing. And so that creates just a more willingness on their part to actually invest. And so it's sort of a different kind of model. And as we think about how venture capital scales, there's like $60 trillion of high net worth assets in the United States, 450 billion of which is in venture capital. That's like 70 base. That's nothing.
Yeah.
That's nothing. Yale has 18% of its portfolio allocated to venture, and the United States has like 70 basis points of its capital allocated to venture capital. And venture capital is one of the most powerful forces for solving tough problems. And so practically what we're trying to do is I want to see that number go to like 2 trillion in venture capital. I mean, if we take everything that's been done in venture capital, like around automotive and telecom and such, and then say, let's apply that to healthcare in a really effective way, or let's apply that to food, or let's apply that to education. I mean, you should be able to bring those prices down and really solve problems. So, if people ate better, we wouldn't have had so many people die from COVID.
Yeah. Yeah, no, absolutely. I think $3 trillion is like what, 3%? Sorry, $2 trillion, like 3% of the entire investment capacity for US, right?
Yeah, I think overall US investment, I don't know how to answer that question. I think overall US investment is, I can't remember the number. I should know that number. But like hedge funds are probably at $2 trillion. But I've done some calculations and around the idea that if we generally were deploying about $2 trillion, if we had $2 trillion in venture capital, the spin-off of that should drive GDP pretty consistently above 3%. And once we're above 3% GDP in this country, every problem that shows up in DC is a lot easier to solve because the amount of growth that we would be seeing. And so on a macro standpoint, we're looking at that. On a micro standpoint, when we look at food as health, not even micro, the numbers are, we spend about 1.7 trillion on food in the United States. We spend about 1.9 trillion on the associated healthcare costs related to poor nutrition. Some of that's direct, someone's got diabetes, some of it's indirect, people dying earlier, not being able to be productive. When we look at that, we see that as a $3.6 trillion market around nutrition. And sometimes I sort of say, the grocery stores should be taking market share from hospitals. Yeah, hospitals are like sitting there trying to solve the problem after it's been caused. But I started my career in doing lean manufacturing type things on production lines, and we made it so that we could build aircraft better by fixing the design process up front. And so if we can deliver food that's better for you and cheaper, then people will make the better decisions, and their diet will get into a position that reduces the amount of cardiovascular disease, diabetes, obesity. When we look at it globally, Even if you don't care about the healthcare implications, and if you don't care about sustainability, and you don't care about the environment, put that all aside, just globally, their economies through the rest of the world are growing. When they grow, more people move into the middle class.
Yeah.
There are 3 billion people supposed to move in the middle class by 2050. When people move in the middle class, they want more protein. Now, that's typically meat-based protein. But I think we said early on, you grew up in India.
Yeah, I do.
India's got, like, I don't understand it as well, but there are kids in India that cheat on meat by eating Impossible Burger. It's like I can have meat, but culturally so I get the meat taste, but I'm not violating sort of some principles that maybe on animals. When we think about the global shift that's going on, there's a desire for more protein for that higher quality food, but that's not decided that that's going to be animal based. And what's happening in the protein world is we're delivering much higher quality protein at a higher production level, that plant-based meats will start becoming cheaper than animal-based meats. And in that process, whether it's in South Korea having a plant-based meat substitute in dumplings, or there are a whole bunch of different things that are going to go on here that we don't even fully understand. But from a pressure standpoint, if 3 billion people move into the middle class globally by 2050, using current food systems, we anticipate that is going to double demand for protein globally. There is not enough farmland in production to meet that demand. And so there's a giant, just system-wide macro pressure to try to boost the amount of protein production. And we need to do that more efficiently, because to get a pound of meat out of a cow, you got to stick 1.7 pounds of protein into that cow from soy or from some type of protein source. And it's just not efficient. And so there's a huge reconciliation going on there that, if you don't care about health, you don't care about the environment, those aren't important things. Just those giant macro pressures create a huge economic opportunity to bring efficiency to the market. And it's all tech enabled. It's not going to be more farms. It's going to be indoor farming. It's going to be better genetics. It's going to be better satellite systems detecting insects on crops using hyperspectral imaging, and then applying drones that have precision sprays on them that then spray that particular area with a engineered biologic that is safe for the environment, and is tuned to that type of crop and that type of insect in that area. I mean, it's just the level of sophistication it's like drug development.
Got it. Interesting. And if you talk about investing into startups, how do you analyze the current seed market? There've been companies like there've been VC firms like Tiger and Anderson Horowitz, who are deploying a lot of capital into the market. But how do you feel about the market with the sort of current fund deployment which is happening, where the timelines have become really compressed, and with the record number of deals happening and the record number of fund which has been deployed in last year? Do you think it's a cause of worry, or do you think it's something which is going to be accelerated because of maybe the remote conditions that we're working in?
Yeah, I think of it in two fronts. I have often thought, you go back to let's go back to lean manufacturing, the sort of craft industry. The venture industry has been a craft industry for way too long. There's reasons to have scale to it. I've always been impressed with Andreessen's got more of a corporate structure to how they're doing it, in which there are people that specialize to aspects of what's being done, and really I've always had a lot of respect for their ability to sort of understand the intricacies of what's going on in that market. And so my just natural inclination is it's going to become a scaled production, precision data driven process. And I think ultimately that's a good thing, especially if as I do, that believe that innovation is a deflationary force, innovation will accelerate things. I'm happy because Tiger A16Z aren't in my market. So we've done like 2 deals with Andreessen. None of them are touching the agriculture market. Even on healthcare areas that we're focused in, none of them are really touching it. And that's our healthcare is a little bit more focused around functional medicine. So I don't know when they are going to show up, if they're going to show up, but I will say that in the area that we are, there are probably about 5 firms that really have the domain expertise, really have it. And we've got a lot of strong relationships with the ecosystem. You know, for example, we're close to farmers that control about 4 million acres of farmland. And that builds what does every startup need? They need an early adopter customer. And so we've concentrated on that. And so I would expect what's going to happen is once, you know, when I look at Silicon Valley, and I have a tremendous respect for everything that it's done in areas like in many of the companies that have been created, there's an intricacy to what we're doing that's a bit more capital intensive. There's more asset-based lending that needs to come in. The corporate structure and how you scale it is different. And my guess is what we're going to see is we're going to see some of the best talent who's been investing in sort of the Silicon Valley model merge in with us, who are some of the early innovators in the ag tech model. And then we're going to merge that together to bring scale. I'm not sure exactly when that's going to happen, but it'll probably happen in the next couple of years. But I welcome it. It's going to maybe hurt a little bit in that process, but we've been in this market early, and we've looked at easily 3,500 deals, been doing since 2014. And we just have a whole bunch of connections that I think as more scale comes in, we can bring the best practices of both together to make a difference.
Understand. And you know, the market, stock market has really crashed. You know, most of the, especially stocks like Peloton and a lot of tech stocks have really taken a beating. A lot of cryptocurrencies have also gone down. How do you calm your mind and, you know, prevent worry and fear when markets crash, and you know, what have you learned, you know, over the years, especially with a 2008 subprime and and the 2000 crash, and even before that, you know, how should people look at you know, assessing the risk and the returns, especially in these times?
Yeah, I think that if you've been through these cycles, you know that you survive them.
Yeah.
And I think that the truth of really great companies is if you really sit down with the CEOs of those great companies and maybe get them to drink a little bit or open up a little bit, it's really the worst of times and their ability to get through the worst of times that mattered more to their success than that they were brilliant to begin with. One exercise, and I do this, we did this when one of our companies went public. I took the picture, if you pull up on Yahoo or Google or something, Amazon's stock price from the beginning till now. It was flat. On that chart, it's pretty flat from 96 through 2011, and then it starts to peak up. So I take that chart and I sent it to him, and then I took every single one of Jeff Bezos's shareholder letters since he's been public. And if you read every one of his shareholder letters, he never kept it a secret. From early on, he basically said in his telegraph exactly what he's going to do. And either people didn't believe it or they didn't read them. So I sent that to our CEO and a company we took public and said, you need to keep these two things in mind. You know, keep telling people your story, and then also recognize that there's still a lot of effort even after you go public to get it right if you're going to really do something profound. And I think that the only thing I would say that gives me anxiety is there an opportunity cost to making it happen quicker? Is there something you didn't do? that you could have done to explain to people quicker. But one of the challenges I've found in the public markets, especially in our area, is I talk to public fund guys or girls, and like, yeah, I'm responsible for our ag tech investments. I'm okay. It's like, yeah, and I know a farmer. It's like, you know a farmer. It's like, yeah, I met a farmer. They own they herd cattle. It's like, that's a rancher. That's not a farmer. And what we've sort of learned is that a lot of the public market investors still don't really understand the opportunity here. And so the other thing that sort of concerns me is, in the case that we do have these downdrafts and it affects our ability to monetize investments or to get more capital in the capital markets to take it to the next step, it's how much of that is that the people on the capital side, their interpretation of what's going on in this market is reading an annual report from Bunge instead of realizing the opportunity that's in front of us. So downdrafts don't bug me. What bugs me is people not realizing that there's opportunity and arbitrage at that point, and what can I do to help educate them? And so that's probably my anxiety is, can we tell the story better or help educate people more quickly? Which is in part why we like to have conversations like this. Is it's a fascinating area. There's stuff I worked on in Boeing in 2000 that's still not public. That's pretty wicked cool. So, all this UAS stuff doesn't shock me. The stuff that fighter pilot was watching, and that kind of stuff doesn't shock me that much. But then I look at ag tech, and people are like, ag tech's a bunch of hayseed guys out in the field doing stuff. And when I look at, like, we're going to use UAVs to deal with fertilizer and crop protection, and we're going to apply it driven by hyperspectral imaging, and it's the same thing as the most advanced aerospace stuff that we did. And I see that. Maybe other people don't see it yet, but it's pretty cool stuff.
Yeah, no, interesting you talked about Jeff Bezos. I think it's a fascinating story from 96 to 2011, 17 years. He's been putting out about his annual reports, and I think for a very long time he ignored the investors, and he just doubled down investing into the growth of the company. And I think he's one of the fascinating leaders in this era. But I wanted to understand, what were some of the biggest misses when it comes to investing for you, and does it impact your style of investing? Because over such a long period, I'm sure that there were some investments where you did not put in the money. It's like an anti-portfolio. But does it worry you, and does it really impact your style of investing going forward?
No, I think it educates you and changes your perception of risk and opportunity costs. And I have certainly, my perspective, I'm psychotic in this. I go back and forth from sort of a Y Combinator broad portfolio deployment and create optionality versus really understand the market and perceive this is the one. And I would say that, I have been an entrepreneur and have been in near-death experiences with startups, and have somehow been blessed at that moment in time with something that saved us. Maybe luck honors the well-prepared. And so I go back and forth between, if there's a surprise in the marketplace and a miss, I really just put it back into a learning to sort of say, try not to make this mistake again. But there's a temporal component where these things just keep shifting. So that lesson learned that you missed then is not applicable again, because that was like a once in a lifetime combination. Our responsibility as venture investors is to give people a diversified pool of investment and manage that risk. And so, sure, I'd love to have more unicorns in my life. But our responsibility in terms of our LPs is to make sure that we give them a 19% IRR. So it's not just looking for the wins. So I'm not sure I've got a good answer for you. You got to take success, failure, learn from it, move forward. I do not think it is possible to come up with the perfect data bot that tells you exactly what to invest in. There is anybody who's been an entrepreneur knows that they're telling the story of their success because things happen to line up at the right moment at the right time, where they never told anyone public that they were about to fail, but they knew they were. and somehow that fell into place. Through maybe good skill, maybe not, but it fell in the right place. And the person who didn't pull that off is lost in time. So.
Yeah, no, absolutely. I think you can never know what's going to work out. But I really like how Sequoia, really puts their head down, like from I think from 1970s. They've just been focusing on just investing to the best of founders and the same work ethic. I think it was Jason Callaghan in his podcast where he talked about that. A lot of investors, quit after 10 years once they have a bit of a success, but maybe there's a playbook, maybe there's not. But interesting insight from you. Kada, I quickly want to do the top three. What's your favorite business book?
My favorite business book. Mostly anything by Tyler Cohen.
Any book in particular?
Well, all Tyler's writings have influenced me in a positive way. Nathan and Taleb's books have all influenced me. I'm a real optionality kind of guy. The other one was a book written called by Bill Danforth's father, and I should have thought about this ahead of time, which was a book written in the 50s about how to behave well in business. And I wish I could remember the title of it, but it's a simple book. It's about 40 pages long. Purina, when it was created, was one of the first companies to do an ESOP in the 50s. And that book was just one that was about proper business practice and grace. And it, given how successful the Danforths were and Purina was at the time, it just was a period of just good behavior.
It's called How to Behave Well in Business, is it? Do you remember the name?
What did you say? What was the name?
How to Behave Well in Business.
Let's see if I can find it while you're asking your questions here. I'll see if it's a build.
Is the author Bill? Is it?
Bill Danforth. I Dare You. I Dare You by William Danforth.
Oh, okay.
It's a very old book. I think it was originally written in, let's see what Amazon says here. It's been republished a few times, but it's, oh, it doesn't say when it was originally published, but it was back in the 50s. It's just sort of reminds you a little bit of just good practice. None of it would be a shock, but it just simplifies, how you should behave in business.
Yeah. Also, I think I've done close to 230 odd podcasts. I think this is the first book which is different from, say, Hard Things About Hard Things. That's the most referred book out here. I'm definitely going to have a look and read it myself. And if you could go back in time when you started iSelect Fund, what is the one thing you would have focused on or done anything differently?
Do differently, or
anything you would have focused, one thing you would have focused on, or if you could go back, if you would do anything differently?
Yeah, I think deepening the storytelling about our mission. I think that when I talk to our employees and our investors, we've got a great set of people around us. And whenever we've run into trouble, they have sort of said, look, you're on the right path, you're going after the right vision. And I think if I could figure out how to tell that story more broadly to speed up what we're doing, I think that we're, sometimes there's a book written by, what the hell is the name of the guy who wrote it? Bill. It was a book on all the startups that have gotten bigger than $1 billion. And he basically observed that virtually all of them, when they got into about 20 million in valuation, the time period to go from 20 million in valuation to $1 billion was 7 years plus or minus 1. But the time period to go from 0 to 20 million ranged from 1 year to 20 years.
Yeah.
Blueprint to $1 billion. It's the name of the book. And when I think about it, could I tell the story better? Could I help people understand? Can I learn more from the people who have bought our product and understand how to communicate that to other people? Because I have this anxiety of how to get to 2 trillion. And I'm pretty sure how to get there, but speeding it up and telling the story in a way to get more people excited. I think the notion of we could be running at 3.5% GDP, that we could be solving problems with entrepreneurial vigor, if we could just figure out how to get people to rethink how they deploy capital. And that keeps me awake at night a lot of times when we get into trouble. It's an important point that I go back to as our anchor point to try to simplify the challenge. And it's something that I just feel like it's an opportunity cost of could we tell the story better?
I think super interesting, and a relevant book that you talk about, Blueprint to $1 billion. We'll put that in the show notes. And do you have any favorite online tools, for example, Gmail, Slack, Zoom?
Yeah, so I'm a little bit crazy on that one. I love reading, and Mark Andreessen has just gone nuts recently with his posts. So I've been following a lot of that Twitter. And I'll give you the link for a Substack that I did recently which was an amalgamation written by another Substack guy around the new industrialists. And there's a crowd of really smart young people, many of them graduated from GMU, that have been focused on this progress movement. And how can we really think about the fusion of policy and innovation in a way to really energize the entrepreneurial spirit broadly? And there are about 5 or 6 people that are working really hard, that are on Twitter, that are very thoughtful. Economics Twitter is very interesting. And they're really doing a very good job of pointing out opportunities where we could do something different in energy and policy and immigration, and they're very thoughtful, balanced perspectives. And so I pay a lot of attention to that. And then through that process, I've created, and we do this on Signal, I've got about 40 people that I have an ongoing conversation with in Signal, where it's all of us having our crazy ideas on various things, and they're all different sorts of people. Signal is sort of a nice place for me to have that conversation because you can make the messages go away. So if you have a crazy idea, you don't have to worry about them ending up somewhere. Yeah. But that is a little bit of what I've curated to try to challenge my thinking and such. But there's a vein within Twitter that's really thinking very hard in this progress movement. And as I say, I sort of summarized them in a Substack post recently that I'll send you if other people want to get access to that.
Sure, love to put it on the show notes. Cardo, what is the best way people can reach out to you and know more about iSelect Fund?
Yeah, so it's very easy. You can, on Twitter, I'm J Carter WIL, and my email is cwilliams@iselectfund.com. And my mobile number is 314-517-7525. And easier to text me or use that number to get me on Signal. Sometimes I think asynchronously better than I do synchronously. So, but feel free to reach out or text me on that. And always interested in learning and meeting new people.
Sure, no, I think that sounds great. We'll put that in the show notes. Carlo, thank you so much for taking our time and speaking to us. I really enjoyed my conversation with you.
Yeah, thank you.